Good day everyone, my name is Kevin Carlson. I'm a mortgage broker here in Canada. Today I'm going to be going over mortgages for the purchase of a home, whether that's for rental property or for a house for you to live in. One of the most common questions that I get as a mortgage broker is, how much down payment do I need to buy a house? Well, the mortgage rules have changed so much over the last 10 years, I can understand why people would assume that down payment rules have changed as well. That is in fact not the case. The only thing that's changed regarding down payment when it comes to mortgages was zero down mortgages disappeared a few years ago. Other than that, down payment has more or less stayed the same at 5% down for the purchase of a house for you to live in or 20% down for you to purchase rental property. As long as you're buying that house for the intent to live in it yourself or a family member to live in it rent-free, you're allowed to buy your first house with 5% down, your second house, and any house after that. There are two main categories when it comes to mortgages for the purchase of property. Each category is separated by how much your down payment is. The first category is called high ratio or insured mortgages. This is for clients who are purchasing a home with less than 20% down payment. The second type of mortgage is called a conventional mortgage. This is for people who are purchasing a home with more than 20% down payment. Conventional mortgages can be for the purchase of a house for you to live in or a family member, but it can also be used for purchasing rental property. Let's go over insured mortgages first. The term insured mortgage refers to default insurance. Now, that's not life insurance or disability insurance. It's a default insurance in case you default on your mortgage or stop making your payments. That is commonly known as CMHC fees. CMHC actually stands for Canada Mortgage and Housing Corporation. That is one of the mortgage insurance companies that you can get mortgage insurance through. CMHC is owned by the Canadian federal government. There are two other mortgage insurers in Canada, Genworth and Canada Guarantee. Each of those mortgage insurance companies provides more or less the same product for the same price. It does the same thing. When you are purchasing a home anywhere in Canada and you have less than 20% down payment, that is a high ratio insured mortgage and you require to have default mortgage insurance through one of these providers. The default mortgage insurance covers the lender in case of mortgage default. Default means that you stop making your mortgage payments, throwing your mortgage into foreclosure. And foreclosure is a difficult legal process that the bank must go through in order to take the house back and then sell it to pay off the mortgage. Even though this mortgage insurance really just covers the bank, you're the one that has to pay for it as the buyer. The mortgage insurance premium is a one-time fee that gets charged as a percentage of your mortgage amount and often added to your mortgage. You can choose to pay this fee up front when the mortgage goes through, but in the last 15 years, I've really only ever had one client that chose to do it that way. That percentage actually decreases for every extra 5% down payment that you put down. So the more down payment, the cheaper that mortgage insurance premium is going to be. The biggest savings on mortgage insurance premiums are at each 5% increment level. So 5% down payment carries the most insurance premium and 15% has some of the lowest. Here are some numbers on the purchase of a $300,000 house in Saskatchewan or a doghouse in Vancouver. So here we have a house with a purchase price of $300,000. If you're putting 5% down payment, that's $15,000. The default mortgage insurance premium is 4% of your mortgage amount, bringing that to $11,400. That's a pretty large percentage. At the end of the day, you're financing 99% of a house purchase in Canada at the 5% level. The 10% down payment, the mortgage insurance premium comes down a little bit. So $30,000 is 10% down payment, and the default insurance premium as of today is 3.1%, bringing you to $8,370. At 15% down payment, that's $45,000. The default insurance premium is 2.8%, bringing that to just over $7,100. One small side benefit to getting a default insured mortgage is that the mortgage insurers actually have a property valuation system in place. So when you purchase a home, they use these automated valuation systems to verify that what you're paying for the house is reasonable and the value is more or less correct. If an appraisal is required, the mortgage insurer actually orders and pays for that report. They do, however, not release the value that's come out as well as the report itself to anyone, so it's really for their own uses. If the appraisal is satisfactory to the insurer and the lender, then they just give a thumbs up and we're good to go. Now let's go over conventional mortgages. Those are quite a bit easier. As I mentioned, a conventional mortgage can be for the purchase of a house for you to live in or a family member, or for a rental property. Most of the lenders that we work with also have internal home valuation models that they can use to help value your home. But if you're putting just the bare 20% down, quite often an appraisal becomes requested. The biggest benefit is no default mortgage insurance premiums. All you have is the mortgage, no extra cost. No matter where you live in Canada, each province has its own provincial land title system. Basically, just a big catalog of all the land titles within the province. A typical residential property will just have one title. Older properties sometimes have one house sitting on multiple lots with multiple titles. When you purchase a property, your name goes on the land title for that property. When you get a mortgage, your mortgage lender will secure against your home as security in case you default on the mortgage. The way they do that is to put their name on your land title as well. So once you've purchased a home, the title will reflect the name and address and legal description of the property you purchased, your names of all the applicants that are on the mortgage, plus the mortgage registration and the mortgage amount. It sounds kind of complicated and expensive, right? Well, that's why we use lawyers to help you through that process. So that process is certainly not free. The land title system has fees and the lawyers have fees. So when you combine these two things, that's called the closing costs. These costs can vary all across Canada. So the banks and lenders have come up with a high estimate watermark on how much legal fees and land titles transfer costs are in each province. And what they've decided is 1.5% of the purchase price encapsulates most of the country. So when you're purchasing a home, you have to keep in mind that you have to have the additional closing costs of 1.5% of the purchase price. So in my previous example, with a home purchase of $300,000, you must have at least your 5% down payment of $15,000, plus 1.5% of that purchase price as your closing costs estimated at $4,500. In most cities, that would be considered high because the legal costs typically are not quite that much. But the banks still want to see that you have at least that much money that you can afford to pay the lawyer bill when the time comes. That's pretty much the basics on mortgages for the purchase of property in Canada. There's quite a bit more detail to go over that I will split up into many other videos coming up down the road. So I would very much encourage you to subscribe to my channel to get notified when more of those videos come up. If you have questions or comments, please either comment below or contact me at my website. Thank you so much for your time and have a great day.